There are days in the market that change nothing. There are days where the price flickers red and green, where the talking heads on CNBC ramble about market sentiment and technical levels, and at the end of the day, the world is exactly the same as it was when the bell rang in the morning. Those are the days of noise. Those are the days of distraction. And then there are days that change everything. Thursday was one of those days. Thursday, February 5th, 2026, will be remembered as the day the paper tiger finally burned. If you are holding silver, if you survived the Friday massacre where they tried to shake you out, if you held the line when the price crashed 25% and everyone told you that you were a fool for holding a dead rock, take a bow, stand up and take a bow, because on Thursday, the market didn't just vindicate you, it canonized you. Silver didn't just go up. It didn't just rally. It exploded, a 7.3% move in a single trading session. Let me put that in perspective for you. In the S&P 500, a 1% move is a big day. In the bond market, a 0.5% move is a catastrophe. In a major global commodity like silver, a market that is supposed to be deep, liquid, and stable, a 7.3% move to the upside is not a rally. That is a violence. That is a limit up type event. That is the sound of a massive, crowded, arrogant trade blowing up in the face of the manipulators. The mainstream media, CNBC, Bloomberg, the Wall Street Journal, they are stunned. I watched them this morning. They are stuttering. They are calling it a dead cat bounce. They are calling it volatility. They are blaming it on technical buying. They are lying. Or even worse, they are clueless. They are reading teleprompters written by the very banks that are currently losing billions of dollars. What you witnessed on Thursday was not a bounce. It was the beginning of the great short squeeze. The bank raid we talked about in the last video, the coordinated attack to smash the price from $120 down to $90, the attempt to break your spirit, it failed. It failed spectacularly. It failed historically. And now the very banks that engineered the crash, the very institutions that thought they could print enough paper contracts to drown out reality are the ones trapped in the burning building, and the exits are welded shut. Today, we are going to do a deep dive autopsy of Thursday's move. We are going to look at the order book. We are going to look at the options market. We are going to look at the physical vault withdrawals that nobody is reporting, because Wall Street will never tell you the truth about what actually happened on the trading floor. They can't. If they told you the truth, the game would be over. But I will tell you. Part 1, the failure of the raid, they blinked. To understand the magnitude of Thursday's explosion, you have to rewind the tape. You have to look back at the Friday massacre. We need to understand the context. Silver had hit an all-time high of $121. The momentum was unstoppable. The retail army was buying. The sovereign wealth funds were buying. The bullion banks, JP Morgan, Citi, HSBC, were sitting on a massive net short position. This means they had sold silver they didn't have. They were betting the price would drop. As the price rose, their losses mounted. They were facing a margin call of biblical proportions, so they executed a raid. This is a standard operating procedure for them. It has worked for 40 years. They wait for a moment of low liquidity, usually 8:30 a.m. or a Sunday night, and they dump billions of dollars of notional paper silver onto the futures market. They don't sell real metal. They sell promises. They flooded the market with sell orders. They triggered the stop losses of the weak hands. They drove the price down 25% to $90. Their goal was psychological warfare. They wanted to create fear. They wanted you, the guy holding a stack of silver eagles in his safe, the guy with a modest position in a silver ETF, to panic. They wanted you to say, oh no, the bubble popped. I need to get out. I need to save what I have left. They needed you to sell your physical silver so they could buy it back cheap to cover their own naked shorts. They needed your liquidity to save their skins. But something unprecedented happened this week. Something that hasn't happened in the silver market since arguably 1980. The retail investor didn't sell. The dumb money wasn't dumb this time. We have data from the major bullion dealers, APMEX, JM Bullion, SD Bullion. On Friday, Saturday, and Monday, when the price was crashing on the screen, their sales volumes tripled. People weren't selling panic. They were buying the dip. They looked at the $90 price tag and said, thank you for the discount. And it wasn't just retail. The whales didn't blink either. The sovereign wealth funds of the BRICS nations, Brazil, Russia, India, China, South Africa, continued to accumulate. They know the paper price is a lie. They are playing a long-term game of resource dominance. So the banks smashed the price on the screen, but they couldn't smash the demand in the real world. This created a spring effect. Imagine holding a beach ball underwater. You push it down with all your strength. Your muscles are shaking. You are using maximum force to keep that ball submerged. That was the banks on Friday and Monday. They were expending billions of dollars of capital to suppress the price. But the moment their strength faltered, the moment they stopped selling for just 1 second, the ball didn't just float up, it shot up out of the water like a missile. That was Thursday. The sellers, the shorts, ran out of ammo. They threw the kitchen sink at the market, and the market absorbed it and asked for more. When a manipulator throws their best punch and the opponent doesn't fall, the manipulator panics. That is the psychological shift that happened on Thursday morning. The banks realized, we can't kill this. And when they realized that, they started to cover. And that brings us to the squeeze. Part 2, the gamma squeeze, the technical trigger. Now, let's get into the weeds. I want to explain the specific mechanics of why the price moved 7.3%. Why not 2%? Why not 3%? Why this violent vertical move? It is because of a phenomenon called a gamma squeeze. In the modern market, prices are not determined by two guys yelling at each other in a pit. They are determined by algorithms and derivatives, specifically options. When you buy a call option on silver, a bet it goes up, or a put option, a bet it goes down, there is a bank on the other side of that trade. They are the market maker. The market maker doesn't want to bet on the price. They just want to collect the fee, the premium. They want to be market neutral. So if they sell you a call option, they have to buy some futures contracts to hedge their risk. This is determined by delta, how much the option moves, and gamma, how fast the delta changes. Here's what happened on Thursday. After the crash, the market makers were holding a massive amount of short puts. They had sold insurance to the bears. As the price started to stabilize on Wednesday and tick up on Thursday morning, the delta of those positions changed rapidly. The market makers were suddenly short delta. To get back to neutral, they had to buy futures contracts. They didn't have a choice. Their risk models forced them to buy. This is mechanical buying pressure. It has nothing to do with news. It has nothing to do with fundamentals. It is pure math. We crossed the $100 psychological level at roughly 10 a.m. New York time. That was the trigger. Thousands of algorithmic trading bots, and I mean thousands, had buy stops sitting just above $100. A buy stop is an order that says, if the price hits $100, buy immediately. Why were they there? Because $100 is a round number. It's a psychological barrier. When the market maker buying pushed the price to $100, the bots fired. Boom. Billions of dollars of buy orders flooded the system in milliseconds. The price gapped from 100 to 103 in seconds, then 105, then 108 hours. The shorts, the hedge funds betting against silver, were watching their screens in horror. They were suddenly underwater. Their brokers were calling them margin call, post more cash, or close the position. They didn't have the cash, so they had to close. How do you close a short position? You have to buy. So now you have the market makers buying to hedge gamma, the bots buying technical breakout, and the shorts buying panic covering. And here is the kicker. There were no sellers. Who was going to sell at $105 when they just saw it at $120 a week ago? Nobody. The longs, the holders, went on strike. They pulled their sell orders, so the shorts had to bid higher and higher and higher. I'll pay 106. No answer. I'll pay 108. No answer. I'll pay 110. Sold. This is called a liquidity vacuum. The price shot up 7.3% because there was literally no paper available to sell. The sellers vanished. This is the anatomy of a squeeze. It is when the exit door is too small for everyone trying to get through it. Part 3, the physical disconnect, the real story. But while the paper price on the COMEX screen was going crazy, something even more important and more terrifying for the banks was happening in the physical market. The paper price is a distraction. The physical price is the reality. We received reports on Thursday morning from reliable sources in the logistics industry. 2 major Asian electronics manufacturers. We suspect one is a massive semiconductor fabricator in Taiwan, and the other is a solar giant in China, bypassed the COMEX entirely. Usually these companies buy futures contracts and stand for delivery. Not this time. They went straight to the refiners, they went straight to the Swiss vaults, and they settled off-market deals. Rumors are circulating, And these are credible rumors that they paid $135 an ounce for immediate delivery of 1,000-ounce industrial bars. Pause and think about that. At the same moment, the screen was flashing $95 or $100. Real buyers were paying $135. That is a 35% premium over the spot price. Why would a smart company pay that? Why not buy the cheaper paper? Because they know the paper is fake. They know that if they bought the paper contracts, the COMEX would default. They would get cash settled. They would get a check back, not the metal. You can't build a microchip with a check. You can't build a solar panel with a dollar bill. You need the element 47. You need the silver. The real price is already at new all-time highs. $135 is the floor. The COMEX price is just a lagging indicator. It is a ghost. The industrial users are panicking. They see the writing on the wall. They know about the AI energy crisis we talked about. They know that AI data centers require massive amounts of power management, which requires silver. They know about the Greenland resource wars. They know the supply chain is breaking. They know that silver is the bottleneck of the 21st century economy. They aren't going to wait for JP Morgan to finish playing their games. They are securing metal now. This panic buying from industry is the ultimate floor under the market. It means the price cannot stay down. If the price drops to $80, Apple buys the whole mine. If the price drops to $90, Tesla clears out the vault. The banks are fighting a war against physics, and physics always wins. You can manipulate paper, but you cannot print a commodity. Part 4, the death of the dollar, the macro tailwind. We also have to talk about the macro picture, the big picture. Why did this happen on Thursday? What was the catalyst outside of the silver market? It was the US dollar. On Thursday, we saw a sudden sharp weakness in the dollar index DXY. It dropped below the key 102 level. Why? Because the bond market is sniffing out the Fed's panic. After the everything crash scare on Friday, the bond market is pricing in emergency rate cuts. The traders know that the Fed cannot allow the banking system to implode. They know that the ghost towers in commercial real estate are about to topple the regional banks. They know the Fed has to pivot. They have to cut rates. They have to print money. When the Fed cuts rates, the dollar gets weaker. When the dollar gets weaker, silver flies. Silver is the anti-dollar. It is the anti-fiat. When you buy silver, you are essentially shorting the US dollar. You are betting that the government will debase the currency to pay off its $38 trillion debt. And that is the safest bet in the history of gambling. Smart money is front-running the Fed. They are buying silver before the rate cut announcement. They know that stealth QE is coming back. They know the money printer is warming up. Silver is the most leveraged play on inflation. Look at the ratio. If gold goes up 1%, silver goes up 3%. That is exactly what we saw on Thursday. Gold was up a respectable 2%. Silver was up 7.3%. That leverage is why we love silver. It is the racehorse. It is the Ferrari. It is volatile. Yes, it bucks you off. Yes, it makes you nauseous sometimes. But when it runs faster than anything else on the board. Thursday proved that the racehorse is awake and the gate just opened. Part 5, what happens next? The path to 150. So the big question, is this it? Is the correction over, or is this just a dead cat bounce before another crash? Let's look at the chart. Technically, Thursday's candle was a bullish engulfing candle. For those who don't know technical analysis, the green body of Thursday's candle completely swallowed the red bodies of the previous 3 days. In the world of charts, this is one of the strongest reversal signals in existence. It signals that the bears are exhausted. It signals that the sellers have left the building. The momentum has flipped 180 degrees. The next resistance level is the old high, $121. We're going to test that level very soon, maybe tomorrow, maybe Monday. But here's the exciting part. Once we break 121, and we will break it, the momentum is too strong. There is blue sky above. There is no resistance. There is no history. There are no bag holders from 10 years ago waiting to sell. When an asset breaks into all-time highs, it enters price discovery mode. The price seeks a new equilibrium. Where is that equilibrium? If you adjust the 1980 high for inflation, silver should be at $150. If you look at the gold to silver ratio, which is currently historically high, and assume it reverts to the mean, silver should be at $200. The math says $150 is conservative. $150 is the base case. And remember, The short squeeze hasn't even squeezed the big boys yet. The move on Thursday was just the weak shorts covering. The hedge funds, the tourists, the bullion banks, the JP Morgans, the Citis, the ones with the multi-billion-dollar positions, they are still stuck. They didn't cover on Thursday. They are praying for a dip. They are hoping this was a fluke. But if the price keeps grinding higher, if we hit $125, if we hit 130, they will get the call from the CEO. The risk manager will walk onto the trading floor and say, close the position, stop the bleeding, take the loss. We cannot risk the firm. When a bullion bank capitulates, when a whale panics, that is when you see a $20 day. That is when you see silver go vertical. That is when the unobtainium phase begins. We are knocking on the door of that phase right now. Part 6, the psychological trap, don't sell. Here is my final warning to you. Thursday felt good. It felt great to see the green numbers. It felt great to be right, but do not get complacent and do not sell too early. The banks are wounded, but they are not dead. They will try again. They will try to smash it down one more time. They will try to create a double bottom. They will manipulate the news. They will put out scary headlines. They want you to think, oh, thank God I got my money back. I'm selling now before it crashes again. That is the relief rally trap. It is the most dangerous trap in a bull market. Do not sell your insurance policy just because the house stopped burning for 5 minutes. The fire is still raging. The debt is still there. The shortage is still there. The banks are still insolvent. Nothing has changed fundamentally except the price is finally starting to reflect the truth. You hold silver for the wealth transfer. You hold it for the collapse of the fiat currency system. You don't trade it for a 7% gain. You hold it for a 700% gain. You hold it until the COMEX breaks. You hold it until the media is forcing you to talk about it. You hold it until you can trade an ounce of silver for an acre of land. Thursday was a warning shot to the shorts. It was the market saying, we are still here and we are taking control. The Wall Street narrative is broken. They told you it was a bubble. It wasn't. They told you to sell. You didn't. And now they are paying the price. I will be watching the markets like a hawk. I will keep tracking the open interest to see if the banks are doubling down or folding. I will keep tracking the physical premiums to see the real price. The squeeze is on. Strap in. It's going to get volatile. It's going to get scary, but it's going to be profitable. Subscribe to the channel. We ride the bull. We ignore the noise. We follow the metal. I'll see you in the next video.